The stock market ended this volatile week up today with all major indexes up over 1% as the Fed's preferred inflation measure for June, known as the PCE, the Personal Consumption Expenditures Index, numbers came out as expected, a 2.5% increase year over year. And then the core PCE, which is minus volatile food and energy, came in at 2.6% compared to 2.5%. That was slightly hotter than estimated. But the month-over-month numbers for both regular and core PCE were in line. This is huge for the Federal Reserve. They want to make sure that they are on track for inflation going down to that 2% level. This report indicates so. I think that's good news. It increases the odds of a September rate cut, in my opinion. And look, you saw that yesterday the GDP report was strong. That's true. But that doesn't mean that the Fed still can't cut rates if the rate of increase of inflation is getting closer to that 2% level, because ultimately the Fed wants to produce a soft landing, and they still want economic growth, but they also want a lower amount of inflation. So if they could produce that, that's a Goldilocks scenario. Who knows if that'll actually happen in hindsight? But I think the Federal Reserve, in my personal opinion, should cut by September. I even think that the Federal Reserve should cut interest rates in the July meeting. Here's why. There's a recession indicator rule known as the SOM rule that if the 3-month current average of the unemployment rate is over 0.5% higher than the 12-month low, then that's triggering a recession, and that usually indicates that the unemployment rate would start going up pretty substantially. Right now, we're close to that 0.5% level. We're about 0.43. So it's something that the Federal Reserve should act proactively and try to get ahead of it, which is why I think the Federal Reserve really should cut interest rates by 25 basis points in the July meeting next week to prevent a SOM rule trigger. If they don't, and if the SOM rule triggers next month, early in August for July unemployment, or September, then that really forces the Federal Reserve to act. And I really want the Federal Reserve, and I think the Federal Reserve should act proactively, because the Federal Reserve is saying that they're data dependent, but that kind of data is backward looking. It's important for the Federal Reserve to be proactive. It's like when you're driving a car, you don't want to constantly look behind you when you're driving on a curvy road, because you want to anticipate what's ahead of you so that you could act cautionary and be a defensive driver. You want to look at the road 50, 100 feet ahead of you. You don't want to have your head turned back, and that's what I think the Federal Reserve should do. I think they should cut interest rates next week to prevent a SOM rule recessionary indicator, and that would prevent the unemployment rate from going up substantially. But either way, we're seeing good news on the GDP front, and we're seeing good news on this PCE inflation report, and that's why the stock market did well today. All major index averages were up 1% across the board.